Boom, we are live, ladies and gentlemen. Thank you for joining us today. I'm just going to be going over our market sentiments, just our general thoughts as kind of things come up. And at the end of the episode, we're going to share kind of our largest version of the thesis on play to earn and where you can find more information about that. So we're just going to dive right in. On the screen here, we have the S&P 500 in pink and Bitcoin in white on the top. The reason we're sharing both of these so closely together is I think it's important to repeat a mantra. If you find something good, lean into it. Since we hit the $60,000 area back in April, I've consistently attested the idea that I thought we were in a larger accumulation range. Now, what that would look like varies. And one of the reasons why that varies is because of a function called scale invariance. There's a fantastic book, if you like reading, by a gentleman named Benoit Mandelbrot. You might recognize this if you are a fan of mathematics. He is one of the originators of the idea of roughness, or what equates to fractals. A lot of high-end engine, like graphical engine, uses these types of mathematics to generate mountains and clouds and a bunch of other kind of hard to code visual expressions of an idea. Now here in the ups and downs of the market, looks probably closest to that of a mountain peak and its ranges effectively. And the S&P 500 here is an interesting comparison because after this accumulation range, we saw the continuation of a bull market, right? Now, one of the reasons this is important for two reasons why this is so important. Now, number one, upside, right? Look how much the S&P 500 on the bottom here, grew here from the initial kind of accumulation range here, which was around 1994 to around 2008, the financial collapse of 2008. Now, one of the reasons why that is important is because, well, first off, scale invariance means that time, or the scale of the function, is unimportant. So when we're looking at peaks of mountains and we're making relative assessments of this type of idea of here's a peak in approximate 2000, here's another peak in 2008. Both of these supposed bear markets were technically the best time to be buying assets, hands down, period. Now, this is from the previous high. And if you go back in Bitcoin's history and you look at 2013, 2017, you look at some of the bull market cycles, what we find is the market cycle runs up and then drops down. And pretty much everything below the drop down was a great place to accumulate. And the likelihood of Bitcoin being in an extended accumulation range here is actually quite high. Now, we could have a lower lateral dip into the $24,000 range before continuing upwards. We may not even see that because this is a limited supply asset in high demand. Now, one of the important parts to remember is that when we're focusing on these long-term macro phases between 2000 and 2008, before the continuation of the bull market, was a long time, you run into ideas like, hey, the hardest thing about making a good investment is being patient and committed enough for the upside. Far too often, we put a very short time horizon on the things that we want to accomplish and then negate, well, first off, the journey, but secondarily, the function and the reason why you see these things. So for instance, the reason why prices go up and down is more akin to the reason why it tries to get you out of the market. Price volatility is designed to play to the downside of people's emotional incongruencies with long-term time horizons and like, hey, what's going to be happening 10 years from now, right? So when in 2001 and 2008, during both of those collapses, it was like, oh my God, it's such a big downtrend. No one likes the bear market, but the bear market is the best time. It's anything below the previous high. And the reason why these markets have continued onwards and upwards with such veracity is because this entire game is held up by capital injection through large interests like federal or central banks. So the S&P 500 is basically, in terms, an effect of this large-scale printing. It's one of the reasons why we're such a big fan of Bitcoin. It represents a step away from that centralized, controlled printing source and gives us a really stable asset in terms of how much there's going to be. Now, it's deflationary by nature of people losing Bitcoin, right? There's 1 million Bitcoin that have never been touched in the Satoshi wallet. And this by itself is actually naturally deflationary. It means that if you lose it, it could be gone forever. But just kind of based off the mathematics of picking a grain of salt or sand from the ocean and getting it right is very difficult to do. So, okay, where does this take us? Right now, what I think we're seeing is a continuation of something very similar to the happened to the S&P 500. And yes, you're thinking, Tio, you said this a few times now. Why do you repeat it? Because the hardest part is to stay consistent in an investment strategy during this long-term accumulation cycle, because it is designed by its very nature to try to get rid of you. So one of the things we kind of measure to make sure that we don't get lost in the market cycle is paying attention to the amount of supply that's on the markets and how it's fluctuating. We have seen a slight tick up, but this also makes sense. There's a potential that we go down to $24,000, and that's a big drop. It's approximately 50% from where we are today. Now, in the grand scheme of things, if Bitcoin's at $1 million in 5 years from now, it'll look like noise. And this is one of the things we want to repeat is right now, we're looking at a pretty short time horizon here. We're only looking with the last few years of market cycle effectively, right? From 2020 is when the bull market started. I believe we're in the mid-range of an accumulation cycle in that bull market, and we can see this by a trading range in the price and a constant declination of supply. Now, again, in the previous cycle drop, when we came down to $30,000, an enormous amount of supply came onto the market. Now, there's a great reason to believe that there's now approximately 1% of Bitcoin supply that has been recovered that may end up going back to, Bitfinex, I forgot where it was hacked from, one of these exchanges, and going onto the open supply market again, or whether they would lock it up or do they try to auction it off. I'm not entirely sure. So we do know that there's another big chunk of supply that could come in effectively that would retest this $24,000 area. So we're prepared for that. And by being prepared for that, again, what we do is we repeat this mantra of, well, what happened in the past? Now, it doesn't need to repeat exactly. What we're looking for is the understanding of that long-term story. So let's go back. We haven't done this for quite a long time. Let's go back and look at the long-term story of how we got here. First off, what you see now on the screen is our long-term drawings. These have not been touched since basically March of 2020, May of 2020. The reason being is we are following this beautiful Wyckoff accumulation range here between $13,000 and $3,000 for multiple years. But prior to that, it's this accumulation and distribution kind of idealized market cycle that we have drawn on the left. Now, primarily it comes up, goes down, accumulates, goes up, comes down, accumulates, goes up, comes down. Now, what's unique about Bitcoin for this particular idea here is that if we go all the way back to the previous bull market cycle, I'm just going to visualize this again for a second. One of the things we recognize is that from the previous high, everything below that high became an area to try to accumulate the asset at, right? So even though, again, holding Bitcoin from $1,000 all the way to $200, if you invested your life savings in it, might feel stupid, it's not until you repeat the investment thesis of accumulation that, lo and behold, just a few short years later, you were up another like 10 to 20x effectively, right? And this has happened a few times. So each time we go up, we get pushed down into an accumulation cycle where everything below that previous all-time high was a great area to accumulate. Now, one of the interesting things here is that way back in 2013 to 2014, you had basically a bull and bear market cycle that lasted a very short period of time. So this is the one that we find most interesting in comparison with today. It was basically from March 2013 to October, January, February of 2014 before it went into the next bull market cycle. This short time frame, even with an extension on here, was approximately 330 days, we'll say. This was a very, very short area where Bitcoin went from effectively $12 to $100, or $200 approximately, 1,300% gains, and then instantly dropped back down and spent 300 days in this accumulation range. So it's not a very long period of time, and that short burst of accumulation then led to another bull market, which was followed by a subsequent down period. Bear markets, again, remember, this is what most people get wrong about the emblematic aspects of a bear. Bears are good at foraging, they're good at accumulating, they're good at collecting assets and keeping them in the bear den. and chilling out, basically hibernating a good chunk of the time, because that's what you need as a good investor. So after that, everything below the previous all-time high at $1,000, if you thought you were unlucky enough to have bought there, became more area to accumulate and more time to get where you were below $1,000 effectively, right? Same thing happens in 2017. Boom, huge bull market cycle. Price runs up to $20,000. Most people don't even become interested in Bitcoin's price until it's up at like 7. You're a first-time buyer. You're buying Bitcoin at 7 grand. And the same thing happened now. Most of you who are watching this video did not show up until Bitcoin was already past $25,000. You missed the early part of the accumulation cycle because, oh, Bitcoin's dead. It's 80% off its all-time highs. No one's paying attention to it anymore. And only those who know how to just consistently focus on an accumulation strategy without getting caught in the hype and the noise and the extravagance of the bull market do really well. They're the people, the bears, who recognize the importance of gathering those assets when they're low. Anyways, just a fun little video. I thought you guys might enjoy that today. Ultimately, we're bullish. Even if we have a quick retest of $24,000 again, which is very, very probable, I do not suspect that it would last very long. I think that we're already like a good chunk through this accumulation cycle. And if we go back to our previous comparison, how we were looking at Bitcoin on top of the S&P 500, it's very likely that what we're going to see is an accumulation range take place here with a wick of maybe $24,000. It could go as low as 17, but if you're lucky enough to have buy orders down there, it's going to get chewed up unbelievably quickly. There are huge interests that are just sitting on the side with buy orders every step of the way and ways to play this game that have that long-term time horizon, because the hardest, difficult part of this whole investment thesis is the patience to find out how right you were. Anyways, it's Deal with the Arcane Bear. Thanks for joining us today. I hope you guys enjoyed today's rant and episode on Bitcoin's price and why I'm ultimately bullish. Again, still, it's going to keep only up effectively, and anything below the only up is a great place to buy. Try to simplify things for everyone. Made a lot of mistakes to get from point A to point B. So if you guys don't make those mistakes, your path to success is ultimately easier. So anyways, we'll see you guys again in the next episode. Boom.